Welcome to the Deep Dive. Today, we're tackling something really fundamental for anyone building financial security, managing investments.
Yeah, it really boils down to that balancing act, doesn't it?
Yeah.
Between the risks you're willing to take and the returns you're hoping to get.
Exactly. And we're drawing on some core material from the CFA program curriculum today. Now, this is, foundational stuff for investment professionals.
It absolutely is. But honestly, even if you're not in the finance industry, getting a grip on these portfolio management concepts can seriously sharpen your own financial decisions.
That's the goal. So we're aiming to pull out the key insights and make them clear and, useful for understanding how investing really works. Subscribe to Sina Channel and like for YouTube.
Right. Let's get started.
Okay, let's jump right into that core tension, risk and return. It's like the first hurdle for anyone thinking about investing.
The basic idea is pretty simple. Chasing higher potential rewards usually means accepting more uncertainty, more risk.
But, and this is crucial, we need to distinguish between looking backward and looking forward. There are historical returns, what investments did earn in the past.
Yeah.
And then there are expected returns, what we think they'll deliver going forward. And, it's those expectations that really drive investment choices.
So how do we figure out those expected returns?
Well, the curriculum builds it up quite logically. It starts with the real risk-free rate. Think of that as the return on a super safe investment after you account for inflation.
Okay, the baseline.
Then you add expected inflation itself because, your returns need to beat rising prices just to keep your purchasing power level.
Makes sense.
And finally, you add the expected risk premium. That's the extra bit of return you demand for taking on the specific risks of that particular investment, like the market saying, okay, this is riskier, so here's potentially a little extra for you.
Gotcha. Now, historical data can really shed some light here. There's this Exhibit 2 in the material. It's quite powerful.
Oh yeah, the long-term growth one. Right. Imagine putting just $1 into different things back in 1900, leaving it until 2018. That dollar in stocks, it grew to like $1,654. It's amazing.
Compared to, about $10 in bonds?
Yeah.
And even less in T-bills.
Yeah, T-bills were only around $2.60. And what's fascinating is the annual real return difference wasn't, astronomically different year to year, maybe 6.5% for stocks versus 2% for bonds.
But over 118 years, that compounding just creates this massive, massive gap. Really hammers home the long-term power.
Absolutely. And Exhibit 3 digs into this further, looking at returns using geometric and arithmetic means.
Right, and the key point there is that the geometric mean, which is generally better for looking at returns over multiple periods.
Because it accounts for volatility, right?
Exactly. It smooths things out. It's usually a bit lower in the simple arithmetic average. But the story is the same globally. Stocks have generally delivered significantly higher real returns than bonds over the long run.
Which brings us neatly to that risk premium concept again. It's basically the extra you earn for dealing with the ups and downs.
Yeah, the difference between, say, stocks and safer government bonds. The data clearly shows equities have historically offered a pretty hefty premium over bonds, even after inflation.
So investors willing to ride out the stock market bumps have generally been rewarded for taking on that extra uncertainty.
Okay, so that's the market side. Now let's flip it and think about the investor. The curriculum introduces this idea of utility.
Utility, like satisfaction.
Pretty much. It's a measure of the satisfaction or contentment an investor gets from their investments. It's not just about the dollar amount, it's how they feel about the return, given the risk they took.
Right, like that classic example. Would you rather have a guaranteed 50 pounds or a 50-50 coin flip for 100 pounds or nothing?
Exactly. Even though the expected payout is the same, 50 pounds, most people lean towards the guaranteed 50 pounds. That's risk aversion. The certainty gives them more utility.
Okay, so how do we visualize this preference?
We use something called indifference curves. Picture a graph. Risk on one axis, return on the other. An indifference curve connects all the points, all the combinations of risk and return that give an investor the same level of satisfaction.
So someone really risk-averse would have steep curves. They'd need a big jump in return to accept even a little more risk.
Precisely. And every investor, ideally, wants to be on the curve that's furthest northwest, highest return, for the lowest risk possible for them.
So they're trying to climb to the highest satisfaction level they can reach, given the investment options available and their own stomach for risk.
That's the goal. It's a personal equation.
Okay, so now let's talk about actually building these portfolios. A portfolio is just, a mix of different assets, right?
Yep, and the overall return is pretty simple. It's just A weighted average depends on how much you put in each asset and how each one does.
Straightforward enough. But then the material brings in the capital allocation line, the CAL. What's that about?
Okay, imagine you have two things to invest in. One is totally risk-free, like a government T-bill, and the other is a risky portfolio, maybe like the whole stock market.
Right.
The CAL shows you all the possible risk and return combinations you can get just by mixing these two. You put more in the risky asset, you move up the line, more potential return, but also more risk. Exhibit 9 shows this as a straight line.
And then Exhibit 10 adds the investor's indifference curves back in.
Exactly. Where the highest possible indifference curve just touches that CAL line, that's the sweet spot, the tangency point. That's the optimal portfolio for that specific investor.
Because someone else with a different risk tolerance might pick a different point on that line.
Absolutely. It's tailored to their utility.
So return is a weighted average, but portfolio risk, that's trickier, isn't it? It's not just averaging the risk of each part.
No, definitely not. How the assets move together is incredibly important. That's where correlation comes in. Subscribe to Cine Channel and like for YouTube.
Ah, right, the diversification idea.
Precisely. The curriculum has this great little example, a beachwear shop and a snack shop.
Okay.
If both do well, only when it's sunny, putting them together doesn't really cut your risk much, does it? They move in lockstep. Perfect positive correlation, basically no risk reduction.
Right, your whole portfolio tanks if it rains.
But then they add a DVD rental business.
Huh?
Maybe not the most modern example, but you get the idea.
Yeah. People rent DVDs when it's miserable outside.
Exactly. Its success is negatively correlated with the beachwear shop. Exhibit 16 shows that adding this can dramatically lower, maybe even eliminate in that specific setup, the overall portfolio risk.
That's the magic of diversification. Don't put all your eggs in baskets that go up and down together.
And the more assets you add that aren't perfectly correlated, things like international stocks, different types of bonds, maybe real estate, the more you expand what's called the investment opportunity set. Exhibit 18 illustrates this.
So adding more diverse stuff can push out that efficient frontier, potentially giving you better risk-return options overall.
That's the key benefit.
Okay, diversification helps manage risk. But then the curriculum makes this really important distinction between two types of risk: systematic and non-systematic.
Yes, this is fundamental. Systematic risk is the big picture stuff. Market risk, things that affect almost everything, interest rate changes, economic recessions, geopolitical events.
The kind you can't really diversify away.
Exactly, it's non-diversifiable. Now, non-systematic risk is company-specific or industry-specific, like a drug trial failing for a pharma company or a bad management decision.
Stuff you can reduce by holding lots of different stocks across different sectors.
Precisely. That's diversifiable risk. And here's the kicker. The market generally only compensates you for taking on systematic risk.
Why is that?
Because in theory, you can get rid of non-systematic risk yourself just by diversifying. So why should the market pay you extra for holding a risk you could have avoided?
Okay. So diversification isn't just nice to have, it's essential if you don't want to be holding uncompensated risk. Example 4 contrasts a risk-free asset with zero risk and the market portfolio, which is mostly systematic risk.
Right. And understanding systematic risk leads us straight into the capital asset pricing model, the CAPM.
CAPM. Okay, sounds important.
It's a cornerstone model in finance. It tries to formalize the relationship between an asset's expected return and its systematic risk. It uses the overall market as the benchmark.
So what's the formula look like?
It's E over I equals RF plus beta I times the quantity, ERM minus RF.
Okay, let's unpack that. E or I is the expected return of our specific investment.
Correct. RF is the risk-free rate again.
Got it. Beta I. That's the measure of systematic risk.
Yes. Beta tells you how sensitive that investment is to overall market movements. A beta of 1 means it moves with the market. Over 1, it's more volatile. Under 1, less volatile.
And the last bit, ERM-RF, that's the market risk premium. The extra return the whole market is expected to give over the risk-free rate.
You got it. So CFPM basically says your expected return should be the risk-free rate plus a bonus that depends on how much market risk beta you're taking on. Higher beta, higher expected return.
Okay. Example 7 uses Bajaj Auto to show calculating beta and then the expected return using CAPM. And if something's totally uncorrelated with the market, its beta is 0.
Correct. No systematic risk relative to the market benchmark. And example 8 shows portfolio beta is just a weighted average of the individual betas.
And CAPM gets used in practice.
Oh yeah. For estimating required returns for projects, capital budgeting, and for evaluating how well investments have actually performed.
But it's not perfect, right? You mentioned limitations earlier.
Right, it's a single-factor model, only considers beta, and it's single period. The real world is more complex, but it's still a very useful starting point.
Okay, so once we have a portfolio, how do we judge its performance, besides just looking at the raw return?
Good question. We need risk-adjusted measures. The curriculum covers several key ones: the Sharpe ratio, Trainer ratio, M-squared, and Jensen's alpha.
Sharpe ratio, I've heard of that one.
It's very common. It measures your excess return above the risk-free rate per unit of total risk, usually measured by standard deviation. It's basically the slope of that CAL line we talked about, kind of a bang for your buck measure for overall volatility.
And Trainer.
Similar idea, but it uses beta systematic risk in the denominator instead of total risk. So it's reward relative to market risk exposure.
And Jensen's alpha, what's that telling us?
Alpha is really interesting. It compares the portfolio's actual return to what CPM predicted its return should have been, given its beta and the market's performance.
So positive alpha means it did better than expected for the risk taken.
Exactly. It suggests the manager added value beyond just market exposure. Negative alpha suggests underperformance on a risk-adjusted basis. M-squared is another one that basically adjusts the Sharpe ratio to make comparisons easier.
Got it. Different ways to slice the performance pie, accounting for risk.
Now, stepping back even further, before any investments are chosen, there's a critical planning document, the Investment Policy Statement, or IPS.
Right, the IPS. The curriculum really stresses this as the foundation.
It absolutely is. It's a written agreement outlining the client's objectives, what they want to achieve, and their constraints, the limitations they operate under. You can't build the right house without a blueprint, right? Same idea.
Makes sense. What goes into the objectives part?
Two big things: risk tolerance and return objectives. Risk tolerance itself has two sides: the ability to take risk.
Like, can their finances handle a downturn, time horizon, income stability, that sort of thing?
Exactly. And then there's the willingness to take risk, their psychological comfort level with potential losses. The Jacques example highlights how these can differ. Someone might be able to afford risk, but hate the thought of it.
That's a really important distinction. And return objectives.
Can be absolute, like, I need to earn 7% per year. Or relative, like, I want to beat the S&P 500 index. The IPS also details constraints: time horizon, liquidity needs, cash flow requirements, legal stuff, taxes, all crucial inputs.
And all this feeds into the strategic asset allocation.
Precisely. That's the long-term target mix across major asset classes: stocks, bonds, real estate, maybe alternatives based on the IPS and long-term market views.
And then things like tactical allocation, short-term shifts, and picking individual stocks are layered on top of that.
Correct. Those are other potential sources of return, but the strategic allocation is usually the biggest driver over time.
Okay, shifting gears a bit. Traditional finance assumes rational investors, but we know people aren't always rational, right? That's where behavioral finance comes in.
Absolutely. It acknowledges psychology plays a huge role, leading to, well, predictable biases and errors in judgment.
The material groups these biases.
Yeah, broadly into cognitive errors, basically, thinking mistakes, flaws in reasoning. These can often be corrected with awareness and better processes.
Like what kind of errors?
Things like confirmation bias, only looking for info that supports your existing view. Representativeness, judging based on stereotypes, thinking a good company is always a good stock. Illusion of control, thinking you influence random events. Mental accounting, treating money differently based on where it came from. Framing how a choice is presented affects the decision.
Wow, lots of ways our brains can trick us. What'll the other category?
Emotional biases. These stem from feelings, impulses. Much harder to correct, often you need to adapt your strategy around them.
Examples.
Loss aversion is a big one. Losses hurt way more than equivalent gains feel good. Overconfidence, believing you're better at investing than you are. Endowment effect, valuing something more just because you own it. Regret aversion, avoiding decisions for fear of making the wrong one and feeling bad later.
And these can affect the whole market too, like home bias or momentum chasing.
Definitely. Things like preferring domestic stocks, home bias, or piling into recent winners, momentum, can be driven by these collective biases.
It adds a whole other layer to understanding markets and ourselves as investors. Okay, finally, let's touch on risk management as a formal process.
Right. It's broader than just diversification. Enterprise risk management is the big umbrella. It starts with risk governance, setting the overall direction, risk appetite, how much risk the organization is willing to take.
And then risk budgeting.
Yeah, quantifying and allocating that acceptable risk across different parts of the business or portfolio. Then you need to identify the types of risk.
Like financial versus non-financial?
Exactly. Financial includes market risk, prices moving, credit risk, defaults, liquidity risk, can't sell easily. Non-financial covers operational risks, process failures, solvency risk, meeting long-term debts, regulatory changes, legal issues.
Lots to consider. How do we measure these risks?
Several tools. Value at risk, or VAR, estimates potential losses under normal conditions. Scenario analysis looks at specific hypothetical bad events. Stress testing pushes the portfolio to extremes. But you have to remember their limits, especially with rare, extreme tail risk events. VAR isn't great at capturing those.
Okay, so once we identify and measure risk, what can we do about it? How do we modify it?
Several approaches. You can try to prevent or avoid the risk. You can accept it, maybe self-insure or just rely on diversification.
Yeah.
You can transfer it, like buying insurance.
Or shift it using derivatives.
Precisely. Things like forwards, futures, swaps, options can be used to shift risk to someone else willing to take it. The currency hedging example shows using a forward contract to lock in an exchange rate, reducing currency risk.
But that might also affect your potential return slightly, right?
It often does. Yeah. Managing risk usually involves some kind of trade-off.
So wrapping this all up, effective investment management is, well, it's complex. It weaves together understanding risk and return, investor psychology, portfolio construction, and active risk management.
It really is multifaceted. But grasping these core concepts from the CFA curriculum provides such a valuable framework for navigating investing, whether you're a pro or managing your own money.
Absolutely. We really hope this deep dive has given you some solid insights and practical takeaways.
Yeah, definitely encourage you to think about your own situation. What's your real risk tolerance, ability, and willingness? What are your goals? How do these ideas apply to you?
And there's always more to learn, whether it's digging deeper into asset allocation or behavioral quirks.
Always.
Well, on that note, thank you so much for joining us for this deep dive. Subscribe to Cine Channel and like for YouTube.